What's up, traders? Anthony Crudele here, and welcome to this week's episode of Develop Your Edge. In today's show, I'll be chatting with trader and host of the Macro Voices podcast, Eric Townsend. I'm going to ask Eric what his edge is in crude oil, why he chooses to trade spreads and use options, and where he thinks the next move in crude oil may be headed. Hang tight while we get Eric on the line. Eric, what's up, my friend?
Great to see you, Anthony. Thanks for having me on.
Great to speak with you. Loving the podcast this year. Macro Voices tuned in all during COVID and really just everything at the beginning of the year with crude oil. You guys did a fantastic job covering everything. And I want to talk to you about your edge today. I've gotten to know you a little bit. You've been on the podcast before. We talked about your process a lot. And I know a lot of our listeners listen to your podcast as well. And I think a lot of people understand, you're macro based and you trade the spread in crude. But I want to know, how did you find your edge?
That's the most important question, Anthony, for any trader, and you know that. If you don't have an edge, you shouldn't trade. It doesn't make sense to. In my case, it was kind of a bizarre story. I was in the process of reinventing myself as a professional investor. I'd retired from the software industry. I'd been active as a retail trader, a retail investor, whatever, but I wasn't taking it seriously as a profession. And I was very much engaged around 2006, 2007 in reinventing myself as a professional investor. And I joined a high net worth investor club in New York City, got to know a few people there that were Wall Street veterans. And there was this one guy, Larry, who was kind of a mentor to me. And he had been kind of like Ira Harris is to you. The guy that you sort of clearly has got more experience than you, that you look up to. And he'd always tell me this, he'd set me straight on things, and I'm learning about technical analysis and fundamental analysis and all that. And one day I said to him, I looked at this term structure chart for commodities, and it's different, from the other charts, the price charts. And what I don't understand, my technical analysis book, it doesn't have anything about it. And he's like, really? Your technical analysis book doesn't tell you what a forward curve chart is? I said, no, it tells you what it is. But when you look at the technical analysis, they're looking at these chart patterns, head and shoulders and cup and saucer and all these. And I can't find anything about how to recognize a pattern in that term structure chart. And he kind of scratched his head, and he had this kind of knowing look on his face, like, okay, the kid doesn't get it. He's like, well, Eric, I got to break it to you. I've been in this business, 30 years. And honestly, I never heard of anybody looking at that. And it hit me like a ton of bricks. I'm like, wait a minute. Nobody ever looked at that? Like whatever edge might, and the way I heard that in that moment was, whatever edge might be possible to gain from having insights from the shape of the term structure on the chart and how it might compare to previous term structures that existed before. The whole technical analysis community for all of finance has never bothered to figure that stuff out. That's what you're telling me. That sounds like an incredible opportunity. So I go and I did this interesting Google search where first I Googled Treasury yield curve PhD thesis. And it comes up with like 2,000 pages of search results and a gazillion things. And there's all these guys that did their PhD thesis in grad school on the yield curve, and then they go off to take their proprietary model that the university probably paid them to develop, and they start their hedge fund with it. And I said, okay, let's do crude oil term structure PhD thesis. And it's like nothing, zero. There were matches because Google always finds a match on one of the words in there, but there was nothing that was about that. I'm like, wait a minute, nobody thinks about this? Well, people do think about it quite a bit. Professional crude oil traders, I think, are more engaged in understanding the shape of the term structure and what it means than they are on the flat price, where a lot of retail traders tend to focus. But it's not in the books. You can't find out about this. And it took me quite a long time, actually, because first I started learning chart patterns from my own analysis. I just went through years and years of term structure charts and saying, well, there's this one pattern. I call it a dipsy doodle. That's just a name I made up, where it's like there's this, because it's what it looks like to me. It's like the beginning of the WTI curve. There's about 3 or 4 months, up to 6 months of contango. Then it rolls off into steep backwardation for about 2 years or so. And then it goes into this much more gradual contango after that. And I call it a dipsy doodle because, and I call the little bit on the left edge of it, right at the front of the curve, I call that the beak because it looks to me like a beak on a bird. It's this funny little hook there. And you see that on the WTI chart, but you never see it on the Brent chart. And it took me years to figure out what the heck, why are they different? Well, the answer is because WTI is a physically delivered contract and Brent is a financially settled contract. And because there's a storage element to it, there's a certain need for the market to price the first few months of the WTI spread into contango in order to allow the guys that are storing oil in Cushing, Oklahoma, to make a buck on that contango yield premium. And if you don't understand what I just said, you can Google these terms and you'll figure it out. But what I learned is, okay, the storage dynamics in Cushing, Oklahoma are different from Brent, which is this financially settled contract based on the North Sea spot price. And that makes this little beak at the front of the curve happen sometimes, but not all the time. And I thought, well, how come sometimes and not all the time? And the other thing I figured out is, wait a minute, these time spreads, they kind of go through a life where for several years, the time spread is kind of brewing farther out on the curve before it gets up to the front close to expiry. And really, at least in WTI, that's mostly about future expectations of supply and demand. Backwardation, when it exists farther out on the curve, means that in that time frame, if we look 2 years out on the curve, we see backwardation there. It means the smartest traders that are putting the bets on in the marketplace think that 2 years out is a time when there's going to be a lot of demand and it's going to be a tight market. The tighter they expect it to be, the more backwardation is there. But even when that backwardation is the dominant theme, if there's a need to pay to store oil in Cushing, Oklahoma, because there's a little bit of short-term surplus, there almost has to be contango just for the first few months. Well, wait a minute. If you know that's going to happen, but not all the time, only when that beak is there on the front of the curve, you can start to say, wait a minute, what if I short those time spreads, not all the way 2 years out, but maybe 1 year out, and kind of sit on them until they get to the front of the curve? Well, that is something a lot of people have figured out, and it kind of works until it blows up in your face. Well, why did it blow up in your face? Well, as soon as you have something like a pipeline spill that affects the physical market, even though it might not have a huge impact on flat price, it's going to blow up those time spreads at the front of the curve to massively high numbers.
Yep.
Well, okay, you can protect against that with calendar spread options. So there's a way to protect that. So I started developing a systematic strategy, which is based on some discretionary analysis, some fundamental analysis of the market, which is what are the factors that cause different parts of the curve to be in backwardation or contango at different times, and what are my expectations about where spreads are going to make that transition to being affected by one factor and then go into being affected by the other factor that puts the opposite pressure on them. It's never 100%, nothing in trading ever is, but there's a substantial edge to understanding the reasons that the back of the curve is affected by different things than the front of the curve. And all of this, by the way, changed completely with the USO ETF blowing up this past year. Because what's happened now is one of the reasons for that contango at the front of the WTI curve was because USO had this ridiculously oversized position in the front month. And not only did they have to roll it every month, but for some reason, nobody can figure out. They advertise on their website. They tell everybody exactly what the date is in advance for when they're going to roll that position. There's all kinds of people that make a fortune front running that.
Yep.
But one of the effects is all those front runners in the market are trying to push the curve into contango there so that they can make a buck front running the USO ETF. When USO changed its positioning, well, we still have contango at the front of the curve, but the change in direction of the curve that used to be very pronounced about 4 to 6 months out on the curve, isn't as pronounced as it used to be. And I think that's because of USO shifting its positioning. So you've got to really understand a lot of different factors that drive this. But frankly, when I first started trading time spreads, I just knew that when the dipsy doodle was in the market, I didn't know what caused it. I had no idea why this crazy pattern was there. But I started saying, well, when it's there, you can make a buck by shorting time spreads about 6 months out and expecting them to decrease in price before they expire. Well, okay, let's go back and look at the history and say, if that's what happens when the dipsy doodle formation is in the term structure chart, what are the conditions that usually exist 6 months before that? And what are the conditions, what are the various times in history when those conditions have existed and that trade was working and then it stopped working? Well, okay, go figure out what caused it to stop working and look for, how do I know when that's coming? And interest rates affect it because one of the things that goes on is people use that contango yield. The reason they're trading it in the physical market is because of what some people call collateral mining. They need an alternative to treasuries that can produce a treasury like yield. So if people are in that trade and that's creating some of the contango at the front of the market, and then treasury yields improve to where treasury yields are a better deal, they're going to stop putting that trade on. And it's going to change the way the dynamics of my trade works. Took me a few years to figure that one out. All of this stuff, it's not like I'm the only guy who gets it, not by a long shot. But the people who know more about this than me are all pro oil traders on prop desks that don't tell anybody how they do what they do. And you don't have to be as good as they are. They're running billions of dollars. You've got the advantage of being smaller in size, that if you can figure out half of what those guys know, you've still got a huge edge, I think, over the guy who's just trading the front month contract on technicals, because there's just so many other people doing that. It's really hard to win at that game. And furthermore, crude oil has so much risk in it that big factors that can push the price huge overnight in either direction can happen out of nowhere because there's a war someplace or whatever.
Yeah.
Generally speaking, when a trend starts where the whole market is moving from structural contango that we have right now toward structural backwardation, and we're not there yet, but it's the way we're headed. Once those trends are cast in motion, they usually take months to play out. And where we are right now, one of my favorite trades is long Z1, Z2, the long the December 21 contract, short the December 22 contract. I've been long that spread from minus 340. And right now, today, we're at minus 64 cents, 64 cents a contango. I think before we get to that spread, the front end of it expiring at the end of 2021, just over a year from now, we're going to be back in structural backwardation because by then the market will have rebalanced itself. I don't know how much, but I think it's not going to be a negative number. It's going to be a positive number. So I've just learned that trying to do what everybody else is doing is very hard to get edge. You want to do what the big boys know how to do, but you want to look for the trades particularly that they don't touch because their size prevents them from doing it. So there are trades that I've really focused a lot of my energy on to say, okay, what is it, and particularly trading further out on the curve than a lot of the pros do. If you go beyond about 18 months on the crude oil curve, there's just not enough liquidity in those markets for guys that are moving billions of dollars around to be active there. So the guys that are smarter than me, and by the way, those guys are a lot smarter than me, they've got so much money they're working that they can't be in parts of the market that I can be in. And I can be in places that retail guys that have as much money as I do don't know how to trade. And that to me has been the niche, and it's taken years to develop it.
All right. A couple things. First of all, everybody, talk about defining your edge. That was awesome. I mean, that was such a great explanation. And just how passionate you are about it and how you took one of your ideas and then you went well beyond it, just that original idea. And how did it work prior to this situation? What happened after the situation? To me, that is about developing your edge. That was awesome. And I want to go to the next part where you talked about your current positioning. And I know, first of all, all the traders out there that are trading crude oil, majority of the retail traders, you heard Eric say it, he and I were talking about this before, they come in and they just trade the outright. And the best energy traders I know are either options or spreads or a combination of both, period. And I just want a lot of the newer oil traders to understand something that you took years to figure out. And like you said, you're not on the prop desk, you're out there, you're your own independent trader. And you talked about this current trade. And I think for some people, it probably sounded a little bit complicated, right? I want you to basically take what your current position is, talk to us how it evolved, and then talk to us about how you go about executing it, simplifying that for the trader out there that's trading the outright, the flat price, and how they could go about and start getting involved with trading the spread, as was like we mentioned, how many of the pros already do.
Well, Anthony, let's start with pre-COVID. At that point, I don't know there's going to be a pandemic. At that time, because of the fundamentals as I read them in the market, I was short time spreads at the front of the WTI curve, and I was long time spreads about a year out. And that's a hedged trade. The idea is that if something kind of blows up, we got one side of the trade will protect you if the other one gets hurt. Once I realized that a pandemic was coming, it's like, okay, I don't need the hedge, the long side. I don't think that we need to worry about prices going dramatically up with what I see on the horizon. So I lifted the hedge and I doubled down on my front of curve time spread trades, shorts at the front of the curve, including the time spread that was most important. You know, people think about that $37 negative price. The more important negative price was actually minus $60. That was the May to June time spread. Because when May went way negative, June stayed positive. And so there was a huge, huge profit that could be made there. I also wanted to bet on the front month going down. It was very tempting to just short the front month, but I already had way too much risk on the table, all on the short side. Just if, you know, there was some crazy nuclear war or something and everything blew up, I couldn't take that risk. So the way I expressed that was with out of the money options, knowing that I've already got so much profit built into my negative or into my short position at the front of the curve that I could spend some of it on options to buy more leverage without taking risk. So I bought a whole bunch of puts on the May and June contracts, which turned out to be incredibly profitable. Once this crisis was ending, though, it's like, okay, now I don't have nearly as much as conviction as I had. So I closed out those trades, took profits, and I waited. And what I waited for is I said, okay, is this really seems to be ending? Well, probably it is. Now it's time to look for the long trade. Where is the buy and hold? And I don't think it's just by the front month because you get killed with the contango that exists in the market. So what I ended up doing was buying what's called the Z1, Z2 spread, long the December of 21 spread, hedged by short December of 22. That market bottomed at minus 360. I was able to get in at 340 average entry. And I've been sitting on that long position ever since. Right now, we're at minus 64 cents. I think we're going to go to several dollars positive before that trade eventually has to be harvested sometime about a year from now.
So a couple things. First off, even though you're trading spreads, as we all talked about, you with Macro Voices, you follow a lot of what's going on in the macro side of things. You can still be heavily weighted more towards one direction like you were back with COVID when short. I mean, you were talking about being short crude oil all the time back then. So you, instead of going to the outrights, you still stay with a spread and or using options, right?
Yeah, you got to trade what you know and what you're experienced with, which for me is the time spreads. If you have an opinion like, hey, S&P is going to crash too. I'm not really an equity trader. I don't know that much about it, but they're going to crash. Okay, fine. Buy puts. Do it with options where you know your maximum loss so that if something you didn't see coming hits you, and even as a professional crude oil trader, I'm not going to go short the front month in size without some kind of hedge, but I'm willing to buy a whole bunch of options with profits that I already made on trades I already closed. I bought a crap load of out of the money puts on May and June WTI crude oil futures, and needless to say, that was a windfall.
The next thing I want to talk about is the analysis that you do on the spread? Because I think that a lot of traders out there are listening and probably saying, well, do you pull this up on a chart? I see a bunch of charts behind you. What is it that you're looking at to maybe help you get in? You talked about how you get in at negative 340. Why at that price? Are you using some technicals to support that? Or is it just because once you have this macro idea, this macro theme of what you think is occurring, you just go to the market? How do you time entries when you're doing spreads?
Well, the first thing is you've got to be acquainted with the forward curve chart, which most traders aren't. So sometimes some people call it a term structure chart, some people call it a forward curve chart. But the chart that shows you a plot of the prices of all of the different contracts, different expiration months for the same product. So in the case of crude oil, it trades 10 years out. And so it's a really big, wide chart, tells you all kinds of information. And unfortunately, there's no book to look up what that means. I've
Yeah.
had to assimilate that from a lot of web searches, a lot of talking to people, and just trying to learn about it. But the basics of it are pretty easy to learn. And I don't know. There must be a book about trading time spreads in crude oil. Most professional crude oil traders are trading time spreads as opposed to outrights. Maybe because that's where most of the money is made. That's the reason no book has ever been written on it. I'm not sure. There's no money in writing books. I know that from having written one. So I don't know. It's taken me 10 years to really learn how to do this, and it doesn't come easily. I wish I had a better answer.
Another thing I want to talk about is how you know which months to choose in the spread.
The which months all have to do mostly with how far until expiration and what events and risks and seasonality you know about that is going to be affecting them.
Okay.
Uh, and one of the things that will happen is, we saw when there were the wildfires in Canada, the front of the curve just got blown out to the upside. And you know that as those contracts come into their last few days before they expire, there's a lot of pressure because of the people that are rolling them that they kind of almost have to get pulled back, at least in the direction of a little bit of contango. And when they're in massive backwardation of like $2 or $3 per month because of the wildfires, and there was a refinery outage and some other stuff that happened, I think, in summer of 18, that's a mean reversion trade where you just say, okay, I get it. I understand the reason these things are blowing up is because there's a very real crisis going on in the Canadian, forests where half of them are on fire. But I also know those spreads have gone too far. And some of that is doing historical analysis to know historically how far can they go? What's the widest they've ever been in backwardation when there was a pipeline spill or something? And how long did it take them to recover? When there's a pipeline spill and it blows the spreads up, a spread that's going to expire in less time than you feel confident the pipeline can be fixed in, you don't want to touch it because you don't know what can happen. But when the spread for next month only blows out half as much as this month's did, but you got 6 weeks before that thing reaches expiry, and you know that most likely they're going to fix the pipeline within 2 weeks, then you really start to look at a mean reversion trade there. So it's understanding the physical market and how it affects these spreads, and how there's a completely different set of factors that affect further out on the curve. And hedging by shale producers is really important in the WTI curve. The shale guys are hedging their production about 2 years forward. They don't directly sell futures, but their bankers do. And that means there's selling pressure that tends to cause that forward curve to kind of find its bottom about 2 years out. Well, if you know that there's these factors and you have reason to think that there's going to be more pressure because you're reading about what's going on in the industry, you know that the bankers are going to put more pressure on producers to hedge more of their forward production. Well, that means more selling 2 years out on the curve. Maybe there's an opportunity to to profit from that spread moving over time from a steep backwardation to eventually moving into contango just before it expires. But then you're going to be holding that spread for a while. You're going to find something to hedge that with. How do you hedge it? Do you do it with options? That gets expensive. Do you do it with spreads elsewhere in the curve? There's a lot of different strategies. It's really understanding that the market is not just the front month contract, it's the whole chart structure. And learning that is not a trivial undertaking. There's a reason that the guys who know a lot more about it than me, and there's plenty of those, they get paid the big bucks. They're running billions of dollars because really, really knowing exactly how all this stuff works better than I do gives people huge edge. And that's what this is all about: is learning as much as you can and trying to get that competitive advantage.
Yeah, and it all is starting to make more and more sense to me now about, first of all, it's experience watching this stuff. You've been spending years watching your edge and how it's played out. And then also, I understand more about how you're using the macro now, because if something blows out on one of the spreads you're looking at, you are gauging, well, how big of a deal is this really? This is way outside of what maybe it should be, and this was an event, and maybe that's an opportunity as well. So it's not just about you looking for an entry on what the macro is telling you. It could be a headline or something that happens to where you're not in, and that creates the opportunity because of all of your macro homework. You say, this is something I'm going to be able to take advantage of here.
Well, I'd say too that Twitter helps a lot. The fact that so many people want to show off how smart they are is hugely advantageous. What I learned is when a spread blows up in the direction I didn't expect, the best thing to do is to proclaim on Twitter that it's impossible and that nobody understands it, because the guy who does understand it just has to prove you wrong by saying, you dummy, you don't understand the reason that spread blew out is because of the wildfire in Canada and what that effect that had on the feedstock that was going in to the Keystone Pipeline and why that's going to cause a shortage in Cushing, Oklahoma in 2 weeks. You're too stupid to know that, you dumb, ignorant piece of crap. It's like, wait a minute, you just taught me a huge amount by insulting me. Thank you. Insult some more. I'm a total nincompoop idiot. Hit me with some more of that. How does that work good. Again?
Yeah.
So the smartest people who really know how all this stuff works, they are out there on Twitter. And when you say something stupid, they'll set you straight. And so I am not afraid to intentionally say stupid things, flaunting my ignorance in a way that causes people to put me in my place, educating me in the process. I like that.
So we only got a little bit of time left, and I want to take you to current day. I talked about how I was tuning into your podcast. You did an amazing job covering when COVID was hitting and the impacts on crude oil. We've talked about that today. Here we are right now, current day. It's almost like crude oil has almost turned the lights off in a lot of ways. It's gotten very quiet, a little movement as of late, but nothing like what we saw at the beginning of the year. What is it that you're seeing on the macro side of things and the spreads that tell you what may be looking to come in the future in crude?
We're starting to finally see the back of curve time spreads performing better than the front month. So the flat price, the technicals don't say anything to me, but amazingly long consolidation. Of course, remember the old adage, the longer the base, the higher in space. So the longer that we coil this market up in a sideways consolidation with no real volatility and no real action, the bigger the setup is for a really big move in one direction or the other. What I'm starting to see, if I can't, I'm not set up to show you, the charts behind me don't show that. The ones in front of me do. As I look at the charts in front of me, what we see is the Z1, Z2 spread, and also I'm looking at Z2, M3, which is the next 6 months. Those spreads are, for the last couple of weeks, staying above their short-term moving averages until the last 2 days, really, where they've had a little bit of a correction. Before that, they were really outperforming the flat price considerably. Sometimes the back of curve time spreads can be an indication of what the smartest traders in the market are thinking, and it's not really affected so much by the short-term news events that tend to drive the front price up and down like a yo-yo sometimes. I'd like to see that follow through. You could make the argument that they were really signaling that an upside breakout is coming in the front month, but in the last couple of days, it has retraced, and we're really testing the bottom end of that support range. If the support that we're seeing in those time spreads holds, and particularly if we move to new highs in the time spreads, I think that would be a signal that the front month is getting ready for a breakout to the upside. It's very easy in a market like this to have a false breakout that then head fakes and goes the other way. And what I'm seeing right now in the back of curve spreads tells me that that is a possibility. So I don't want to make a directional call. But what I will say is the back of curve spreads are well ahead of what the front month chart is doing. So if you understand the message they're telling you, you can wait and see how that resolves before you put your trade on the front month. And that's something I think a lot of people don't understand is they say, well, I'm not going to trade spreads so I don't have to learn about them. If you're just trading the flat price, the front month, the back of curve spreads can give you a huge amount of insight as to where the smartest traders think the market is ultimately headed.
Yep.
And that's really important. And because when they differ, it's an opportunity. When the back of curve spreads are saying this is a bullish chart, but the front month is selling off dramatically because some, Libya had some bomb blow up or whatever. It's like, wait a minute. I know that whatever the news is in Libya is going to blow over. It's creating a short-term buying opportunity. The back of the curve is telling me that the next major direction is up. Time to buy here. And of course, that could go the opposite direction. You could see the opposite action that was telling you the opposite thing. One way or another, the more that you can understand about the whole market, the term structure, the long-dated contracts, the better you'll understand the front of the market.
Yeah, those are great points. And I wanted to tell all the traders out there when you were saying that even if you're not going to go and trade the spreads, listen to Eric and watch him if you're a front month trader. Eric, this was so much fun. It's always great to speak with you. Everybody check out Eric's podcast, Macro Voices, one of my favorite financial podcasts. You do a wonderful job. Eric, thank you so much, my friend, for joining me today.
Great to be here, Anthony. Thanks for having me.
Hang tight, traders. I'll be right back with my final thoughts.
24/7 access to diverse global markets. Right here.
That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready.
Well played.
Why trade with TradeStation? It's innovative, easy to use, and totally freaking sweet. With powerful tools to track and execute your trades and low per trade commissions on stocks, futures, and options. Upgrade your trade at TradeStation.com.
Final thoughts for today, traders. Talk about defining your edge. I love that about Eric and how he explained it's not just about his strategy, it's the entire process, it's the entire package. I think that we as traders so many times get caught up in just finding a perfect strategy. Well, when you hear Eric talk today about his edge, it's about the entire package. It's about understanding the environments. It's about doing the macro homework, how that plays into the execution with his technicals, the spreads, using options. It's not just about having a single strategy that I think a lot of us look for and just try to get a high probability strategy. It's about being the entire package. I think that is extremely important when developing your edge as a trader. Now, today, we talked a lot about Crudele. Go to activetrader.cbgroup.com. Gives you all the specs you need to know about crude oil and mini Crudele. And remember, traders, if you have any questions or comments, please put them down below. You could also follow me on Twitter at Anthony Crudele. And don't forget to check out Instagram at Anthony C. Crudele. That's a wrap for today. See you next week.